Welcome to a new video. Today we're talking about the ADA US dollar pair. And yeah, let's just talk all things ADA, right? Is this the real breakout here into the next parabolic phase? And if it is, what targets can we expect? How to navigate this environment? And yeah, much more. Let's dive in. Now, let's start with a quick overview. What is the macro situation for ADA? Well, I mean, it's actually easy to see. This is an uptrend, right? You have higher highs, higher lows, and the momentum is bullish. Both lines, the MACD and the signal line, are above the zero line. I think it was February for the first time in this cycle. Both lines were above the zero line, right? And so you could say the bull market, momentum wise, it just started, right? It's just picking up. So there should be something more. There should be another huge outbreak in momentum. The RSI just bounced here, right? The last time we got below the moving average here in green, we spent a couple months and then bounced again and started a new uptrend, right? This time we went below and immediately bounced back, and we should see another move to the upside. And yeah, at least test the overbought area. I don't expect this, just because how unique this market was back then in many terms or many aspects. I don't expect to replicate that we can replicate this, but we should at least test the overbought area, right? So it looks like we get another spike here. We should at least. And yeah, momentum wise, it looks good, right? We are picking up steam, right? Momentum is building. Now let's put on our formation trader hats for a second and try to identify the patterns here. So what we can see here are falling wedges in a contracting variety or fashion. And yeah, it shouldn't wonder us, because a falling wedge contracting within a bull market resolves to the upside with a chance of, I think it was 74% according to Bulkovsky's data, according to Bulkovsky's studies. And yeah, so it shouldn't surprise us, right? It is a bullish pattern within a bull market and is consistently breaking out to the upside here. Now let's have a more detailed look into this wedge here, right? Let's try to dissect what happened over the last 6 to 7 months, right? So you have this, overall this is a complex correction, right? When a formation trader sees a wedge, we Elliot wave trader, we see a more detailed version of this wedge. We see a complex correction, right? So we saw an ABC here, a connective wave, and another ABC. That's not very visible here on the monthly chart. Let's go into the weekly and let's label it real quick. So you get the parabolic breakout move here, and the move to the upside. Local top here in December 24, a first ABC. There are two impulses. If you go into the lower time frames, you can clearly see it. So I'm pretty sure this should be an ABC. You then get another ABC. It could be an ABC zigzag, could also be an ABC flat, depends on the time frame you're looking at, and if you prefer looking at a candle closes or wicks. But in the end, it doesn't matter, because this is just the connecting part, right? This is the part that connects this corrective structure, this ABC, with another corrective structure, which appears to be another ABC, right? So we saw this A, B, C. I'm labeling it prematurely, so I don't know right now if this is the ultimate form of this correction. It could extend. We could do something other than keep going up to the upside, right? We don't have a technical confirmation now for this breakout here. So this pattern it's technically it technically looks complete, but we have no confirmation for it to be complete at this point. So let's put this on. This first ABC is a W. It's just the first part of a more complex correction. It got connected by an X, another ABC, either flat or zigzag, and got finished off by a Y, another ABC. So this is a sharp complex correction, right? A double zigzag, two zigzags tied to another, where the second zigzag really couldn't get much deeper than this low, just because of how brutal this move was, right? This was a huge liquidation event and probably even market manipulation. So what is some psychology behind this? Let's further dissect this. You have this part here, this first ABC, and this is where people got scared out, right? Liquidation event 1, liquidation event 2. You have this fake out part where we again have a lot of liquidations, right? If we draw a trend line here, people really believe this was a breakout, and I was together with the news, with the ADA reserve news, I was almost convinced myself that that this is trend continuation, but it was too good to be true, right? So lots of people longed here and got liquidated in the next week. Right? So it was the big fake out move. So another event to remove leverage, right? And this probably final part was just the boredom phase, right? I mean, we more or less moved within a range, right? It was just this, and people got bored out of the market. Maybe a final scare here in the end. And that's pretty much it. I think the structure it just makes sense from a market psychology perspective. From the technical aspects, it makes sense from the Fibonacci time aspect, from the Fibonacci retracement and extension levels that we hit here, right? You could also think of it as a triple bottom, or at least a double bottom here, right? With the candle closes. We are accumulating confluence, more and more confluence, that this here is actually the bottom for this correction. But is there more evidence for a potential bottom? What else can we find? Now, just simply, let's draw a trend line here. So we have a first touch here, a second one here. Then we have this this overreaction that got corrected immediately. So I would say you can actually ignore it. The price respected, at least partially respected this resistance here. Got above it, hovered above it a little bit, bounced on it, and since then we are breaking out again, or creating more distance again. So to me it looks like we are going to diverge away from this trend line. So what is the momentum saying? We have a momentum divergence. We have lower lows in price, right? Low, even lower low. And we have the histogram bars that are reducing, right? So you have a decreasing selling pressure on the MACD, but lower lows on price. So this is a bullish momentum divergence. You have the price bouncing back here above the MA, which is also bullish. This is what you want to see. Let's also look at the bull market support band. Yeah, we tested it, or we're currently testing it. It would be very bullish to close a weekly candle above it. And if we do it, we will very likely going to take this high here as well. So if price can take 80 cents, if we can break through 80 cents in a convincing fashion, close candles above it on the higher time frames like the weekly chart, it should be pretty much the confirmation that this corrective structure here is indeed over. So what else can we see? Is there even more evidence? Yes, and I think this is even more convincing, at least to me. As an Elliott wave theorist, I'm counting the waves, I'm looking at the wave structure, and if we look at this price action here, the potential breakout, if we look at it on the lower time frames, we can very clearly see impulsive behavior. Right, here's the potential bottom, and you can see a first 5 waves to the upside in a wave 1. You see a complex, or it should be a flat correction. It doesn't matter, a 3-wave correction here in the second wave. Another impulsive breakout. This is where I was a little bit scared. I thought maybe this is an ABC, and we then continue downside for a final leg. At this point, I wasn't totally convinced that the correction is over, but yeah, we held important Fibonacci levels, right? It was the 0.618 where we could see this bounce, which is very impulsive. So here you have a double 1-2 structure. If you make a potential bottom, or if you actually make a bottom, you want impulsive price action to continue the overall trend, and it's not just one straight line up. It has to be built up, right? You have to build a base for parabolic price action. This here is parabolic. It is parabolic. You can't have parabolic price action without building it under normal circumstances. Of course, a very bullish news can create a pump out of nothing, especially in very illiquid titles. But if you're dealing with serious assets, before you can have real parabolic price action, you just have to build a base so that it can actually happen. And we have this here. We have 5 waves to the upside in a wave 1. We have a 3-wave correction into wave 2, and then we have another 5 waves up. At this point, you could have labeled it A, B, C, and then downside continuation, but no, it didn't happen. We bounced off from this very important bounced off of this very important Fibonacci level, but in a very parabolic fashion. And this now, it is primed to go higher. This is parabolic price action, and this is very corrective. At this point, you can see the difference between parabolic price action and corrective, very overlapping price action. That this is just a stop before we go higher. So expect to go higher. This is absolutely parabolic. Here, something new, in my opinion, happened, and this impulsive price action will lead to more upside, to at least this local high here. Now let's get into the final part of the video, where I will show you a few Elliott wave scenarios that I think are more probable, and yeah, let's calculate some price targets based on Fibonacci extensions and retracement levels. So let's begin with the bearish scenario. The only bearish scenario that makes somewhat sense that I could think of is that we never left the bear market, right? We did a wave A to the downside, and now we are in a wave B, or we already finished B and are in an early C, right? So let's begin with the slightly less bearish variation within these two scenarios, where B is not in yet, right? So let's just pull the retracement targets. The most common area for the most common retracement area for a wave B is the 38.2% level. Let's take percents. Is the 38.2% level, and the next likely one is the 50%, and so on. So most of the time we are moving within this range if it comes to a B. And in the slightly less bearish scenario, the B is not in now yet, and it could, yeah, it would hit the 50 or 61.8% level most likely in that case. Let's complete it. Let's complete the move for B, A, B, C, right, for W, whatever correction in X. And now we are in the final part of this complex correction to the upside into Y. So this is another A, B, C, and Y. So this ABC or this C leg, we could be in the C leg, and the C leg should, let's just measure it by candle closes. It's just a little bit more reliable, and it should bring us to, yeah, at least $1.30, and yeah, more likely $1.50, right? Somewhere between the 38.2 and the 50% level it should terminate. I mean, this wave C, it could extend into the 161.8% level. It would be close to $2. In that case, we would reach between the 50 and 61.8% level, right? Between $1.60 and $1.99. So this is the most bullish bearish scenario I can think of right now. In the more bearish scenario, we are already hit the top of B here, right at the 38.2% level, and we are in the wave C already. And let's also dissect the wave C. It should be an impulse then. We would be in the second wave. First wave we already did, and the second wave we are working on now, before eventually going into the third wave to start the capitulation phase. This is the most bullish scenario I could think of right now. This is the 1-2, 1-2 setup. So the last 2 years were actually a somewhat of preparation phase. We had one impulsive breakout, it failed, then another one, it again failed, but people here were not that bearish. Were not as bearish as they were here. So you have a small progress in psychology, but still enough people left the market that will come back here and fuel the rally with a lot of FOMO. So you can put another box here. This is the, yeah, let's call it the parabolic phase, right? This is the third wave of a higher degree trend, or third wave, right? So this is where the trend most of the time has or naturally has the least friction, because people actually start believing the trend is real, right? This is where the people realize, yes, that's it, we are actually in a bull run after all, and they FOMO in. And you can actually even look at this third wave here. This is the third wave within a third wave within a third wave, and this is the most parabolic part. It should be this wave here, right? We do a first wave, second wave, we are going to correct here. It's not a one straight line to the upside, and then we go into the third wave of the third wave of the third wave, which should break this resistance here. And I don't even think it will stop here, because 50%, it's not really a Fibonacci sequence number, right? It's just a percentage number. The next sequence number in the Fibonacci line is the 61.8% level, so $2. I think this third wave of a third wave will lead us to above $2. Maybe this wave here, it could see some resistance before $2. Let's draw it a little bit more accurately. So the first wave should pinch here into this resistance area. We see a correction, we consolidate here then, and then the final blow comes, and it should hit, it should break this level, it should break the 50% level, and I think it will test at least the 61.8 level before it goes for a final blast off above $2, right? So $2 until this wave, and then above $2 to finish off this third wave of the third wave. So this is easy to see, the most parabolic line, and it just makes sense, right? It's the wave where most people are convinced it's breaking every resistance. It is straight to the upside. it is very bullish. This is when people will start believing, holy shit, that's it. Most people will enter here. They will not enter here, and they will, of course, not enter here. They will enter here, and they will enter here. Right? This is why. This is how a move like this can happen. It's because a lot of people are entering this rally late, very late. Right? If we are seeing the sequence, if this is going to play out, this is where people are entering them. Right? About between $1.50 and $2, the most volume will enter the market. So once the most of the volume is in, right? Most of the hype is over. Price is starting to struggle, right? So we can add another box. So the third box. So this is the phase where we work on the 4 5s, right? This is the third wave, and then we are starting to work this waves of surprising disappointments, right? The first surprising disappointment here, 4 5. Another surprising disappointment, 4 5. Another the final surprising disappointment before you actually go into the final phase. So this is the model, right? The model case. Speculative at this point. We just have this 1 2, probably the beginning of a nested impulse. Does not have to be. We don't have guarantees in this market. It's just a projection we can work on, we can theorize about, right? So now let's look at the targets. So the third wave of a third wave, this third wave here, right? We want to see where can this move terminate actually. Let's look at the most likely targets. The third wave of a third wave most of the time hits the 200% level, sometimes this level, and yeah, it's quite rare, but it sometimes happens. So most of the time it's moving within this box here. But these both here are not that likely, so let's just rule them out, just to take only the highest probabilities. Let's rule them out. So if we are not looking at this special case of wave 3, not the third wave of a third wave, let's just look at the regular wave 3, right? So the most probable target is the 161.8% level. And next 141.4. So these are really unlikely. I mean, if you have a third wave that just hits these levels here, it's likely not a third wave. It's more likely a C, a final wave and a correction. So we can also, by probability, rather rule them out. So we are stick with this range here. Let's put in another box. So for this third wave of a third wave, we should calculate. We could expect between $2 and $2.64, and we can actually even make this smaller here. Let's say, actually, really, most of the time we are hitting this level here. We can even rule this out. So it's $2.20 and $2.65. This is a likely area, right? So it should terminate somewhere between the 61.8% level, which is at $2, and the 88.6 retracement level, right? So more or less to $2.70. This is a realistic target based on Fibonacci and Elliot waves for this wave 3 of a wave 3, and every other extension to the upside or move to the upside, this is for later stuff, right? Let's not bother with this right now. We are not there. We can talk about once it is the case, but if this sequence actually really plays out, right, if we can see this nested impulse in its eternity, then we can clearly calculate with prices above $3, so new all-time highs. It's possible. Is it possible within this year? I don't know. I don't think we are doing this sequence here in this year. Maybe the cycle extends into next year and it's possible. Maybe it's Q1, Q2 next year, right? So possible, but again, it's not for today. We are just looking on what is imminent, and imminent by this model, right? If we're looking at this case here, it would be the third wave of a third wave, and this is the most interesting, the most parabolic. This is the most percentage gains most of the time, most percentage gains wave within and impulse. Okay, that's it for it, guys, and for this video. And yeah, see you in the next one. Like, share, and subscribe if this helped you, if you think others should see this, if you want to create a little bit of hype around ADA. I would appreciate it if you share it, and I try to upload more videos in the future. Can't stick to a specific plan for now, but maybe I would try in the future. I can't promise anything, but yeah, I'm a little bit motivated. Let's see how things play out. Good luck in the bull run, guys.